Hello and welcome to Money and Life TV. My name is Mike. Welcome to 2018, everybody. And since it's the start of 2018, what better topic to start off with than tax reform? In today's video, I'm going to be covering in plain English many of the 2018 tax law updates that will affect your personal tax return. If you're new to our channel, I just want to take a moment and say welcome. If you're somebody who's interested in learning more about finances, more about how taxes work, more about investing, then I would highly consider subscribing to our channel, as we produce new videos every single week surrounding those subjects. And we also produce videos that are going to help you in your career and your life. If you find this video helpful, please don't forget to hit that like button before you leave. All right, let's get started. Just a reminder that for 2017, for this tax season that's coming up in April, remember, you're still going to follow the 2017 rules, okay? Many people are getting it confused, which is easy to do. These new tax law changes are really going to impact the return you file in 2019, okay? So just keep that in mind. We're still, for 2018 on April 15th, we're still going to follow the 2017 tax law. All right, ladies and gentlemen, I thought the easiest way for me to show you this information and talk about the Tax Cuts and Jobs Act's 2018 tax reform bill was actually to just show you on screen so that you have a visual of everything we're going to be talking about. So what I did is I made a spreadsheet, or I put together a spreadsheet based off many sources. And just so you know, here's some links to the sources I used to create this spreadsheet. If you want more detail, or if you feel there's something, hey Mike, you didn't cover that, well, check out those links. There's a ton of information in there, including a link to the actual legitimate tax bill itself. Now, if you've never seen a tax bill, what it looks like, you can actually find them on the congress.gov website. So, but I already have it up. So just so you know what a real tax bill looks like. Oh my goodness, it's a real tax bill. This is what it looks like. So once they've, battled it out in Congress and it's went through the House, the Senate, the Ways and Means Committee, and all those different places, then they get this bill finalized. And as you can see, if you have trouble sleeping at night, then please feel free to read this. It's 185 pages of legal jargon about taxes.
Ain't nobody got time for that.
What more could you ask for, really, ladies and gentlemen? I couldn't ask for more myself. I have not had trouble sleeping since. But this is where the official bill is, and this is where you can read it. But anyways, so let's go to this spreadsheet I put together for you. And I have a nice little present for you, is the spreadsheet itself. So what I'm going to do is I'm going to put a Dropbox link to this spreadsheet so you can download it for yourself and you don't have to recreate the reel or anything. And what I did to create this is I read probably 20 to 30 pages of information, and I pulled what I felt to be the most important aspects of this tax bill for your individual taxes. Now remember, we're just talking about individual taxes, and put them together into tables and visual forms in the spreadsheet. So all you have to read it is Microsoft Excel. If you don't have Microsoft Excel, I'll see if I can get it to you in another format, but just, let me know. And like I said, I always do recommend you do your own research on this kind of stuff if you want to learn more. So let's go ahead and get started. So let's start off by talking about rates, because that's one of the biggest changes that has just occurred, is the tax rates themselves. So revised tax brackets. And I'm only showing two statuses here, if you file single and if you filed married joint. Why? Because those are the most two common filing statuses that are out there. As you can see, the 10% is still pretty much the same. However, overall though, the rates have decreased, okay? So this, like the 12% bracket, I will tell you that used to be 15%. The 22% bracket used to be 25%. So basically, the tax bracket rates reduced on average by 3% per bracket. If you want to know more of how tax brackets work, then I highly encourage you to go check out this video I made about how federal income tax brackets work. And I tried to make it fun by using a stuffed animal to explain how taxes are calculated. So check it out. And I think you'll find it helpful if you don't quite understand how this actually calculates out and how it impacts your paycheck. Speaking of paycheck, you might want to check with your payroll department of your company or firm, wherever you're working at, and see what they're doing with your withholdings. Depending on who you are, you might have to up with your withholdings, depending on how much income you make. or you might decrease it a little bit if, with these new tax savings. So it just depends. Okay, one of the major changes is with the standard deduction. What they've done is they've basically took the standard deduction and they're going to double it for you. So you're going to get a higher standard deduction, which means in plain English, you pay less tax. So it's not a bad thing at all. So in 2017, you can see that if you were single, your standard deduction was $6,500. If you were married, it was $13,000. Well, look at 2018 now. In 2018, if you're filing single, your standard deduction is now $12,000, and your married filing joint standard deduction is now $24,000. Very nice, very nice. So that is very pretty. And with it being $24,000, I expect even less people to itemize than before. So the next thing let's talk about is personal exemptions. So the standard deduction is more favorable for us. However, what they did in this new tax bill is they took away personal exemptions. And so when parents said, "Oh, remember when you were growing up and your parents said, well, we're going to claim you on our tax return." Well, when they said we're going to claim you, what they really meant is that we want a deduction for claiming you on our tax return. And that deduction they were talking about is the personal exemption. Well, what they've done in this new tax bill is take it away. So before then, every exemption or every person you claimed, like your spouse, your kids, etc., that for each person, you were getting $4,050 in an income exemption. So it reduced your income. So what they've done essentially is for 2018, that the whole idea of, the more kids you have, the more higher deduction you can get. That's not the case anymore. They've taken away personal exemptions. So it doesn't matter if you have 1 kid or 10 kids, you're not going to get that personal exemption. You're not going to get that $4,050 per child anymore. For 2017, you will. Just remember that. But for next year, in 2019, when you go to file your tax return, you're not going to have that anymore. So that's kind of the downside. So they've given you more of a deduction for your standard deduction, but they've taken away your personal exemption. Let's go ahead and move on. And as you're watching this, guys, feel free, ask me questions, leave those in the comment section down below. I'll do my best to respond. I know a lot of this information is still brand new, and there's a lot of work that still needs to be done to sort all this stuff out. So I will do my best to answer your question to the best of my ability. So the next thing. So since they did take away personal exemptions, obviously a lot of people are not happy about that. So to kind of offset that a little bit, they've also increase this child tax credit, which is a good thing. That means for your taxes, that's a good thing. It's going to help you save tax. So as you can see here in 2017, the credit amount was up to $1,000. The refundable amount, and the child tax credit, is a refundable credit, which means even if you owe no tax, if you get this credit, you'll still get a refund, which is great. So what they've done for 2018 is they said, okay, well, we're going to up that credit amount to $2,000, and if a person ends up owing no tax at all, well, we're still going to refund them $1,400 of that. So they've given you a slightly better child tax credit. So that's pretty cool. Let's go on to state and local taxes, which is, if you might have heard the acronym SALT, well, that's what it is. That's what they mean when you hear the term SALT, state and local taxes. So this one is big. This is one of the biggest changes they made. And so what they did is they're going to limit how much we can deduct or itemize for state and local taxes. Now, you would not, unless you itemize. Let me just make this clear, because a lot of people don't really, and this is nothing bad, but a lot of people don't understand tax. So unless you're able to itemize, you would get no benefit from these state tax deductions anyways. But if you did itemize, these deductions were huge. In fact, they were crucial in allowing you to itemize in the first place. So in 2017, as you can see, all state tax amounts are deductible. Your property taxes, your state income taxes if you live in a state where you pay income taxes like California, New York. I'm sure there's plenty others that you guys can, name off the top of your head. Those are 2 examples. And also included is things like your sales taxes, property taxes, etc. Now in 2018, as you can see, this is limited now to $10,000. So, up to $10,000 in total, meaning of all of your state income taxes, property taxes, whatever, once it hits that $10,000 mark, it doesn't matter. You cannot have any more than that. They're limiting you to that amount. So basically, if you're somebody who works in a high income tax state or pays a lot of property taxes, this is going to hurt you. And if you heavily itemized on your tax return to save a lot in tax, you're probably going to end up paying more tax because of this new bill, unfortunately. Okay, let's go down to mortgage interest deductions. I saw a lot of confusion around this one. A lot of people were saying, "Oh, I need to go sell my house, or I need to go buy a house right now before these new tax bills take effect because I won't be able to deduct my mortgage interest." Well, that's simply not true, and it just shows how much of a lack of understanding there is when it comes to taxes. So with mortgage interest deductions, your mortgage interest is still deductible. Let me make that clear. Your mortgage interest is still deductible. So let me show you the difference right now. So in 2017, your mortgage acquisition, meaning you took out a mortgage to buy a home. In 2017, you were allowed to have up to $1 million in mortgage debt, and you would still be able to deduct that mortgage interest, if you were able to itemize. Follow me? The mortgages existing before 2018 will not be affected. So if you already have a mortgage, you're fine. Don't even worry about it. You have nothing to worry about. It's only dealing with mortgage acquisition debt you incur after or starting in 2018. And also in 2017, your home equity loan interest is deductible. Big change here. In 2018, that is going to be no longer the case. So in 2018, your home equity loan interest is no longer going to be deductible. So if you think you can borrow a ton of money from your home take a huge home equity loan and buy all this stuff and still be able to deduct that extra interest, you're going to be out of luck. So keep that in mind. So that's a big one. That's a big change. But now let's take a look at the interest for mortgage acquisition debt. So you can still take out a mortgage up to $750,000, okay? So it's really not that different, right, from $1 million. And you can still deduct that mortgage interest. So that's the mortgage interest deduction. So let's go ahead and move down to the next one. I'm going kind of fast, but you guys just let me know if you have questions. Miscellaneous itemized deductions that are subject to 2% floor are repealed. So what the heck does that mean? So basically it means if you had unreimbursed employee expenses like your job travel, union dues, job education, etc., legal fees, tax preparation fees. So normally you'd be able to deduct your accountant's preparation fees if you were able to itemize. Now it's no longer going to be the case. I'm an accountant. As you can see, I'm not too happy about that one because obviously my clients want to be able to deduct what they pay me. Investment fees, safe deposit boxes fees, etc. You're no longer going to be able to deduct those as itemized deductions. But once again, unless you itemize, it doesn't matter anyways because you're going to get the standard deduction. Let's talk about education. There was a lot of heat around education. And initially, a lot of the education credits and so forth were up for grabs of being impacted or repealed. But luckily, those are still in effect. So as you can see, what I wrote here is education credits will remain unchanged. There will be some modifications to 529 plans and ABLE plans, but I am not aware of the details of those changes at this time. So that's what I've heard. If you know where those changes can be found or if you want to know more, let me know, but I don't know the details of those changes. This is something to be aware of. Okay, let's go ahead and what about your 401k? There was a lot of talk about your 401k deductions being limited. So, what you contribute from your check to your 401k, they left it unchanged. They didn't touch it. So contribution rules are still the same. So basically, if you're working somewhere, if you're part of your employer's qualified retirement plan, you can still defer up to $18,000 of your income to your 401k. And if you're under, sorry guys, my phone's going off. Let me turn this off real quick. My mom is trying to bombard my phone while I'm trying to film this video. Okay, and if you're under the age of 50 with your 401k, you can contribute up to $24,000 of that, okay? So 401k unchanged. I just want to point out this one, the alimony. Oh, this is where it gets interesting for me. So this is big, guys. So normally, just so you guys know, if you have a spouse and you're divorced and the court orders you to pay alimony to them, then whatever amount of alimony you give them, let's say it's like $10,000, okay? Well, that amount you would not count in your income because you had to pay that money to them. And they would include it on, your ex-spouse would include that on their tax return. So this is interesting. So with this new alimony change, the spouse who pays alimony is no longer allowed an income adjustment. It's like, what? So now get this, and the person who receives the alimony no longer has to claim the income. Now, when I first read this, I was thinking, okay, so at first I'm like, okay, maybe they just, it's a more conservative party that's in office right now. So maybe they just want to encourage longer lasting marriages. But I don't know. So if you were, now, hear me out for a second. If you were thinking about divorcing your spouse and you knew there was a good chance to get alimony, wouldn't this be even a greater incentive to leave your spouse? Because you're going to get tax-free money from them. You don't even have to claim it anymore. I'm not a fan of this one. Anyways, that's just my opinion. But tell me what you guys think. What do you guys think of that new ruling? Because I know some people who pay out a lot in alimony, and I think the fact that they cannot deduct it is completely unfair. But that's just my opinion. Anyways, enough of that. So let's move down into federal estate tax, because this one is massive. Now, federal estate tax is huge. It's a huge deal. Now, honestly, probably less than 5% of the entire population is affected by that. But by it, it's in fact only less than 1 in 10,000 people have to even file an estate tax return. But you might have heard that this bill does benefit the rich. Well, of course it does, because that's all tax bills, if you haven't noticed, generally favor business owners. And so, of course, if you're super wealthy, of course, you're not going to like the estate tax. So what they did, they couldn't completely repeal it. So it's still in effect, but they've doubled the exemption amount on it. So in 2017, if you were single, you had basically $5.5 million, as you guys can see here, $5.5 million in assets. Anything above that, you would have to pay estate tax on. And if you're married, if you had around $11 million in assets, anything above that, you would have to pay estate tax on. And just so you guys know, if you don't know what estate tax is, it's freaking brutal. It is so, and I'm not rich at all, and I hate it. So imagine that, just to give you a brief idea of what estate tax is without going into too much detail. Imagine you worked your entire life. You saved, you scrimped, you worked your butt off, and you built your own business. You saved up millions and millions of dollars. You were responsible with your money, and you came out well. You didn't inherit it. You became well off. And let's say you were single and you had $10 million now, okay? $10 million in assets when you die. Well, in 2017, you could say, okay, well, of the $10 million, anything, or of my exemption of $5.5 million, anything above that is subject to estate tax. So what the IRS does is that if they would come in, they would see your $10 million and they would say, well, you have $10 million. Your exemption is only 5.5. So $4.5 million of that is subject to estate tax. And because we feel like you have too much wealth, we're going to tax you on that remaining $4.5 million in assets and tax you at 40%. That's right. That's basically what estate tax is if you're too well off, when you die, the government steps in and basically taxes you once again and takes nearly half of your wealth. So the estate tax is ugly, and I hate it. I hate it personally. But what they've done with this bill, and this is greatly, as you can see, this is gonna, once you know that, I explained that, this is gonna greatly it's going to greatly help out people with a lot of assets. So now if you're single, you can have 11 million in assets before paying any estate tax. Now, if you're married, you can have up to $22 million in assets before paying any estate tax at all. So remember, anything over these amounts is taxed at 40%. But that's a huge benefit for people with a lot of money, a lot of assets. So that they're very happy about that. And it's going to greatly impact estate planning going forward. A couple other things, we're going to start to wrap this up. So alternative minimum tax. So just real quickly, if you're single, your exemption amount is around $70,000. If you're married, it's around $109,000. This is for people who make a lot of money. This alternative minimum tax is not something that affects most people. It's highly complicated, so I'm not going to go into detail on that. If you want me to, I can make a separate video on it. But it's a highly complicated tax topic. It's very complex. There's also a new alternative minimum tax phase-out amount. So the phase-out begins at $500,000 if you're single, and the exemption amount is $1 million if you're married. Affordable Care Act. So this one's big. So let's read it. It says, repeals shared responsibility requirement for full coverage health insurance. So as you guys know, let's step back for a second, that once Obamacare, or the Affordable Care Act came into play, you would be penalized if you and your family did not have full coverage health insurance. So what they're doing with this is they're going to start repealing that penalty, meaning that penalty is no longer going to be in effect. However, if you don't have health insurance. However, it is still in effect in 2017, and to my knowledge, it's still going to be in effect for 2018 as well. I'm not sure about the 2018 part, but I would expect that you're going to need to have full coverage health insurance to avoid penalties for 2017 and 2008. So a couple other things I thought that really should be mentioned, because a lot of people might be wondering, is capital gain rates essentially going to remain the same. They're going to be indexed for inflation, so that no changes there. Casualty theft losses no longer applies unless a federally declared disaster. So if somebody steals from you or damages your property, can't really get a deduction for it anymore unless it's something like a major fire or a tornado, hurricane that's declared a federally declared disaster. Moving reimbursement. This one's interesting. Moving reimbursement and moving deduction suspended for most people except armed forces. So basically now if you're moving from one job to another, you're no longer going to be able to get the moving expense deduction starting in 2018. So just keep that in mind. Unless you're part of the armed forces or military or something like that. Charitable deductions. So a lot of people are wondering about, okay, what about if I donate to charity? How does that impact me? Is that still a thing? It's still in play. Before, in 2017, it's limited to 50%. You can donate up to 50% of your adjusted gross income and still get a deduction if you itemize. So once again, if you itemize, then it matters. If you don't itemize, it doesn't matter. And with the new higher AGI threshold now is 60% instead of 50%. I don't know if this is going to impact donations to charities yet. We're going to have to see. But, if we're going to find out who is really giving to be generous versus who is giving for tax deduction, because with the new rules, the new tax rules, it's less likely that a person's going to be able to itemize in the first place. So maybe they don't donate as much. We'll see. I don't know. What do you guys think? How do you think that's going to play out? Now, if you guys want more detail on any of the stuff we talked about today, check out these articles. There's one from H&R Block that did a nice little recap. And I think they have a lot of the business stuff in there too. And also check out the official bill if you'd like to really know how that works, or if you want to see the real bill and need help falling asleep at night. There's a great recap by Tony Nitty. He's a writer for Forbes, and it's like a 20-page article, but it's in plain English and it's pretty easy to understand. Pretty much most of what we talked about, and I forgot to mention at the beginning of this video, is most of these tax changes, to my knowledge, are going to expire at the end of 2025. After that, I don't know what they're going to do. Like I said earlier, if you want me to do a video on the business updates or the tax law business changes, let me know. I can put one together. And that's pretty much it, guys. I just wanted to cover many of the key points. If I didn't cover something and if you have a question, I'm happy to respond. Let me know. I will do my best to answer your question. And I can also, point you to some resources as well. So hopefully I've explained this in a way that will help you and it makes sense to you. So if you liked the video, make sure you drop a like. Let me know that you liked it. Share this information with a friend, especially this information, especially the spreadsheet, because I'm going to leave it in the description section below of this video. You're going to find a link where you can download that spreadsheet for yourself. Feel free to share it with others. Feel free to share it with your friends, because I do think this video is going to be really helpful for a lot of people and clear up a lot of confusion. I couldn't find anywhere on the internet that summarizes some of these main points like this. I had to do it myself because I couldn't find it. So that's why I've summarized this information for you. Hopefully it's nice and easy to follow. And if you have not already subscribed to this channel, be sure to subscribe, because every single week, Chipper and I produce new videos that are going to help you improve your financial position, your career, and life. And we do that by teaching you more about your personal finances, investing, taxes, and more. So thank you for taking time out of your day to watch this video. I hope you found this information helpful. And until next time, I love y'all, and I will see you in the next video. Bye, guys. Peace.